Why care? Because we care. This Care Investment Philosophy video is designed to explain what an exchange-traded fund is and how they assist to protect, grow and benefit our clients' wealth. Due to the significant amount of Australian exchange-traded funds contained in care portfolios, it is an important component for clients to understand. So what are exchange-traded funds, also known as ETFs? The definition of an ETF is a trust structure of individual listed companies wrapped up into a single listed security on the Australian Securities Exchange, ASX, and given a three-letter code. Hence, an ETF essentially is listed the same as any listed share. Most Australian ETFs attempt to replicate or positively track a group of shares. For example, the top 300 ASX-listed companies. This is known as index tracking. That is, the ETF passively holds companies restricted to the relative index universe, such as the top 300 ASX-listed companies, but with scope to adopt different weightings towards each individual company. In contrast to the passive nature of Australian ETFs, there are ETFs available in Europe and the US, which are more aggressive or active type ETFs. Two examples of active type ETFs called leveraged ETFs, which provide greater than 100% exposure to the underlying index, and inverse ETFs, which, as the name implies, are designed to negatively correlate with movements in the underlying index. Importantly, care portfolios only contain the passive style Australian ETFs. To better understand ETFs, we first need to look at a list of commonly held shares on the ASX. Each share on the ASX is represented by a three-letter code known as an ASX code. For example, let's consider a few commonly known Australian listed companies such as Woolworths, Telstra, Commonwealth Bank of Australia and BHP Billiton. The three-letter ASX code that represents Woolworths is WOW. The Telstra ASX code is TLS. The BHP Billiton ASX code is BHP. And the Commonwealth Bank of Australia ASX code is CBA. Let's now look at an example of purchasing a single share on the ASX. If purchasing some CBA shares, you can see that it would cost you in broking fees around $30. When selling shares, it would generally cost you another $30. If you were to construct a full portfolio with some of the top 10 ASX listed shares, it would generally cost you around $300 to buy in and $300 to sell, totaling $600 of broking fees. So how does an individual share compare with an ETF? Let's say we were to add to our list of top 10 shares an ASX-listed ETF called VTS. VTS stands for Vanguard World Total Stock Market, which comprises of multiple large companies like Google, Apple and Microsoft. Say we purchased VTS and added it to our top 10 portfolio of shares, making it 11 total securities held. The share brokerage fee upon purchase of VTS would be $30, with a management fee of 15 basis points, which means for every $10,000 invested, you would have an ongoing management fee each year of $15 to have all of those listed companies wrapped up and reported on. You may ask, how many listed securities or stocks does this one ETF, VTS, hold? The answer is, you will have exposure to more than 3,700 companies, including the top 10 global companies. You can see you're getting a large diversification and exposure to high-quality companies for the price of one listed security. What do you receive with the purchase of VTS ETF? Fantastic value for money. Great exposure to the top companies. In general, VTS ETF ongoing fees, also known as management expense ratios, MERs, are considerably cheaper to the VTS investor compared with other ongoing fees charged with other managed fund providers. VTS ongoing fees are only 15 basis points or $15 for every $10,000 invested. For example, it's not uncommon to pay double or triple with other managed fund providers. Now let's move on to another example, where we're going to add a Vanguard Australian Shares ETF called VAS. What is VAS? If we look at an index chart, the blue line is a representation of the top 300 performing companies on the Australian Stock Exchange, which is exactly what VAS attempts to replicate. So the VAS ETF would give you exposure to around 300 Australian companies, including the larger companies, also called large caps or large capitalised companies, such as Westpac, Telstra, CBA, BHP, ANZ and Woolworths. The weighting towards each individual company in the VAS ETF is determined on a percentage basis, depending on the capitalisation size of the individual company relative to the overall ASX 300 companies. For example, the two largest companies within the ASX 300 are CBA and BHP. Therefore, based on their large cap size, a higher percentage is weighted towards holding these two companies. Now let's look back at isolated parts of the CARE portfolio we've constructed. We have, for example, 10 individual stocks potentially under the enhanced component. And we've now added, for example, the VTS ETF, 3,700 global companies, and the VAS ETF, 300 Australian companies, into the core component, which diversifies our portfolio across approximately 4,000 individual companies. Now, say an investor with $100,000 wants to invest into VAS ETF. Here are some examples of how the $100,000 would be split across each share according to its capitalization weighting in the market index, as follows. So we can see then, with one ETF trade, we benefit by gaining exposure and access to a multitude of companies, which instantly diversifies our portfolio and helps reduce specific company risk. So what are some other benefits to you when using ETFs to invest? Number 1. Expertise of Vanguard, BlackRock, Russell Investments and SPDR State Street Global Advisors, who are world-leading expert ETF and index fund managers. 2. Diversification. Massive exposure to lots of quality companies you otherwise would not get exposure to. 3. Great asset allocation. Exposure to hard-to-get investments like gold, commercial property, government bonds, and emerging markets, including rapidly growing economies such as Brazil, Russia, India, and China. 4. Flexibility. ETFs trade like a share. You don't have to go through the process of managed funds investment. 5. Annual tax reporting is all taken care of for you. 6. Liquidity. You can see the number of securities on issue being bought and sold every day. 7. Transparency. You can see the price on the ASX every day. 8. Investor protection. ETFs are a trust structure that must be registered with ASIC for an extra level of governance. 9. ETFs are low cost compared with managed funds. 10. ETFs mirror an index so that capital gains tax is very minimal. 11. GPS Wealth's CARE investment portfolios use a range of ETFs in the core and active components to provide you with all the benefits mentioned above. Additionally, we understand that investing is a complicated world, so our advice is most valued when we make it easy and simple for you to understand. Australian ETFs allow passive investment across a broad base of high-quality listed companies and form part of our CARE investment portfolios, which are designed to help you focus on having an exciting life and boring money, and not the other way around. Finally, ETFs are a great way to protect, grow and diversify our investors' wealth and fit well into the CARE investment philosophy. Why CARE? Because we care. And we use ETFs to help you get there.